You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to the Investor Way. It's the 15th of November 2024, and on this week's episode, we'll be discussing ASOS, AutoTrader, Taylor Wimpey, Novo Nordisk, Persimmon, and our US company of the week is Fiverr. John, do you want to start off with ASOS?
Yes, so it's struggling along there with Boohoo. They had their full year results out last week, with ASOS's underlying revenue falling by 16% to £2.9 billion on a like-for-like basis, in line with previously downgraded guidance. Increases in average basket value were not enough to offset fallen consumer demand, and order levels were down significantly. Underlying cash profit, EBITDA, was at the top end of the group's prior expectations, but still fell 44% to £80.1 million, impacted by lower sales and heavy discounting to clear the inventory. Free cash flow improved from an outflow of £213 million to an inflow of £37.7 million, and that was helped by a much higher operating cash flow and lower investment expenditure. Net debt, including lease liabilities, remained broadly flat at around £600 million. And in the new year, gross margin is expected to improve by at least 3 percentage points to above 46%. Underlying cash profits are expected to grow at more than 60% to between £130 and £150 million. And on the news, the shares were down around 6.5% in early trading. In terms of valuation, ASOS has a market cap of £436 million and trades at a forward price to sales of 0.14, compared with a 10-year average of 1.14, and obviously not paying a dividend. I mean, I thought these results were very disappointing. I suppose it's what we've come to expect now over the last 18 months with both ASOS and Boohoo. I know there's a turnaround strategy that's going on, but I think ultimately with both ASOS and Boohoo, it's a battle that they are losing. They have, with ASOS, sold off the Top Man and Top Shop brands, which has brought in some cash. But I really don't think, unless something drastically changes with Temu and Shein, I can't see ASOS or Boohoo really competing. The market has shifted massively. And I think on the other end of the market, rather than the Temu and the Shein, you've got Next, which is operating at that end. So it's really, really difficult to see a way forward, I think. And I do still own my Boohoo shares, but I'm on the verge of selling them. I think if I had ASOS, I'd be at the same point too. Sam, what are your thoughts on these results from ASOS?
I just think they're really bad. They've been bad for a while. I think what annoys me of it is, when they're talking about underlying cash profits, the EBITDA, but they've been telling us they've been having underlying cash profits, whilst cash has just been streaming out the door for a couple of years now. And I know they've now got it to an inflow, and they've said that they're expecting to grow it to between 130 and 160 million. But then the problem is, I don't know what the interest is going to be. I imagine it's quite high with the amount of debt they've got now because it's built up pretty quickly. I don't know what the tax will be. Probably don't need to worry about tax because they're not making any money. And then depreciation and amortization, again, I don't know. But it's just difficult because if cash keeps flowing out the door, they can tell us the EBIT does as good as they want. And I know cash has just stopped flowing out the door, but it's just very, very concerning. I think free cash flow is probably key at the minute, given the debt and the state of the business. And the free cash flow is not great, although at least they are now back at an inflow. I think for Boohoo, the situation is actually worse because Boohoo, at the start of this wobble, was still beefing up the American business, which if it had worked would have been fine. But then the sales have continued to decline, and they've now got all this infrastructure in America that they probably don't need, and where the money probably could have been better spent. So I think Boohoo's in even worse shape, as shown by the fact that they've just announced an equity raise. But yeah, I sold mine I can't remember when, maybe 6 months ago. I sold at about the same price as it is now. I think it was around 30p a share. It was more the fact that I just didn't see any positive future for it. I don't mind giving a business time, but for me, it just reminded me of a lot of when I used to hold Debenhams, where I don't see a way out. And I think the fact that I know we're talking about Boohoo now instead of ASOS, but I think the fact they're raising equity kind of suggests they're kind of getting towards the end of the line because it's not a good position to be in. So yeah, I just wouldn't touch ASOS or Boohoo. That being said, if you put a gun to my head and made me buy one of them, I'd probably go for ASOS at the minute.
Out of interest, what do you think? Because about Mike Ashley's role, because he's got a significant stake in ASOS and in Boohoo. He may even be the largest shareholder in both. Would you back him to be the chairman or chief executive of Boohoo?
If I was a shareholder, I would be voting for Mike Ashley because love him or hate him, he does know how to run a retail business, I think. And I think current management have done so poorly that I can't really see him coming in and doing worse. It's kind of like, you're in February and you're 20th in the league. And it's like, well,
Yeah,
probably just, it's like we were saying when we were chatting about it on WhatsApp the other week, where he probably is the big Sam of
yeah.
British High Street. It's the Sam Allardyce of the British High Street. So if I was still owning shares, I would be voting for Mike Ashley because I don't see how he comes in and does a worse job.
Well, that's true. What would you think about a merger of the two?
I don't know. I don't know what it achieves as a thing because they're just two totally separate websites. I guess if you are going to get cost savings, but the problem is I think the state both these businesses are in, you can only get so far by cutting costs.
Yeah,
At some point
yeah,
they do actually need to turn the business around and start growing again. So
yeah.
cost cutting buys them more time and there might be synergies if they merge, but it doesn't solve the underlying problem for me.
No, fair enough. Okay, on to a much better business then.
Yes. So we're now moving on to AutoTrader. AutoTrader have come out with their half year results, and AutoTrader revenue is up 9% to 283.5 million, and Autorama revenue is down 10% to 19 million, with group revenue overall up 8% to 302 million. AutoTrader operating profit was up 7% to 197 million, and Autorama operating profit was up 50% actually, because it's gone from a 5.6 million loss to a 2.8 million loss. And group operating profit overall was up 14% to 188 million, and that's due to central costs reducing. So it looks like last year they had a lot of central costs relating to the Autorama acquisition, which were one-off in nature. So those central costs are 57% lower this year. And the operating profit margin is down 1%, 70% for AutoTrader. And the group operating profit margin is up 3% to 62%. Basic earnings per share is up 22% to 15.56p. And cash generated from operations is up 9% to 201.6p. They have returned £122 million to shareholders, and that's up from £117 million last year in the half, through 64.9 million of buybacks and dividends of 57 million. And they've also declared a dividend of 3.5 pence a share, up from 3.2 pence a year ago. Operationally, they've highlighted that over 75% of all minutes spent on automotive marketplaces were spent on AutoTrader. Cross-platform visits were up 7% to 82.6 million per month, and cross-platform minutes increased to 560 million per month. The average number of retailer forecourts in the period increased 2% to 13,986. Average revenue per retailer per month was up 6.3% to 2,852 on average, driven by a positive contribution across all three growth levers. Live car stock on site was up 2% to 448,000 cars on average. This increase due to a higher volume of private listings. So they delivered 3,180 new lease vehicles, a segment which continues to be impacted by limited supply. The average number of so that's probably why Autoram was struggling actually. The average number of employees in the group increased to 1,252, and that's up from 1,220. They did say that the impact of the UK digital services tax, as previously suggested, was recognised for the first time with a £5.1 million charge in the first half. Retailer revenue grew in line with expectations at 8% year on year, with the number of retailer forecourts stronger than anticipated, increasing 2% year over year. Due to this growth being from smaller, lower yielding retailers, this has had a dilutive impact on average revenue per retailer, which, coupled with the market dynamics described below, increased 6.3%. Over the past 6 months, their marketplace and competitive position has continued to strengthen. Cross-platform visits have grown 7%, and they're now more than 10% larger than their nearest competitor. They continue to make good progress scaling their Deal Builder product, which enables car buyers to value their part exchange, apply for finance, and reserve a car on AutoTrader. In the last 6 months, they saw 23,000 deals, which was more than 10x the number seen in the same period last year. The new car retail market remains challenging, with a 10% decrease in first half volumes on depressed levels seen in the prior year. Despite an increase in discounts being offered by manufacturers, total registration volumes were broadly flat, with the fall in retail volumes being offset by growth in the fleet segment. Since January, the share of battery electric vehicles as a percentage of total car sales increased to 18%, although it remains short of the 22% target required under the zero emissions vehicle mandate for 2024. Despite this weakness in the new car market, they continue to see strong levels of demand for used cars, with a record number of cross-platform visits in the first half. As they move through the first half, supply constraints have emerged, limiting vehicle availability. The combination of high demand and restricted supply has led to cars selling at an increasingly faster rate. During the first half, the increase in overall used car transactions corresponded with the 5% rise in the number of unique cars sold through AutoTrader. However, due to the fast speed of sale and cars being advertised for shorter periods of time, this has not corresponded with an increase in live adverts, with retailers benefiting from an increased utilization of AutoTrader's slot-based advertising model. Therefore, even though consumer activity and retail use of the AutoTrader platform have both increased, it's not directly benefited revenue. Used car pricing has been broadly stable over the last 6 months, having declined through much of the last financial year. In terms of valuation, the business trades at a forward P of 24 and has a dividend yield of about 1.2%. I thought these results were pretty good. Basically, what we've come to expect from AutoTrader. The Autorama is a bit disappointing with the 10% drop, but then if they're struggling to get new cars and that's then flowing through to struggling to get leasing offer leases, what can you really expect them to do? And it's just a tiny percent of the business anyway. And really, it's all about that core AutoTrader platform. I don't know how the move to electric would affect them longer term, but I think certainly in that transition period, it's probably a good opportunity because I think it probably would push up used car prices if people don't want to move to electric, and manufacturers over the next however many years are being forced to make X percent of electric cars. So potentially they do actually have some tailwinds, but the problem is then if you do end up in a position where everything new being sold is fully electric, I don't know how that impacts AutoTrader. So you've probably got a combination actually of tailwinds and headwinds. But overall, I think very good set of results. I don't think the valuation's outrageous. I think at a value of 24, I think for a business of this quality, or a forward P of 24, I don't think it's outrageous. But that being said, it's definitely not cheap. What do you think, John?
Yeah, no, I do like it. I suppose the question is, what the future of the growth is. And as you say, there are quite a lot of uncertainties there. I own, and we come to this point quite a lot. I do own Rightmove, which I feel is quite a similar business. And I haven't gone into AutoTrader, perhaps because I own Rightmove and some of those uncertainties, but it does seem to be fantastic in terms of how it's being run and the overall strategy. So not one that I would bet against. Probably wouldn't buy one at, buy in at the shares at 24 times forward earnings. That being said, it's incredibly high quality business, and yeah, I think you could do a lot worse.
Got Rightmove. I think it's probably the best comparison. The valuations are usually fairly similar between the two. Rightmove's got better operating margins, and I think as well in terms of the longer term, in 10 years' time, I don't see a scenario where people have moved away from Rightmove. I know we hear about On the Market and whoever else that's trying to take market share, but I think it's so entrenched. I think it's incredibly difficult. Whereas with AutoTrader, again, I don't see anyone else taking AutoTrader's spot, but then I'm not sure where the market is moving in terms of the move to electric vehicles and how that potentially affects them. Whereas Rightmove doesn't have that. I think in 10 years, people will still be buying houses that look pretty similar and are pretty similar to the houses we have today.
Yeah, no, that's right. And I suppose the government is, whether it's electric vehicles or not, they are disincentivizing people from, their own personal vehicles as a whole. I wouldn't say that you're not going to have cars, but you feel that there potentially more headwinds for the market overall than there are for the housing market. And interestingly, in terms of the valuation, they're quite similar at the moment.
Yeah. So
So
speaking of the housing market, then should we move on to our first house builder of the week?
yeah, that's right. So Taylor Wimpey, they had a trading statement out last week with figures from the mid-year point. Taylor Wimpey's average weekly net sales rate rose from 0.51 to 0.70 compared with the same period last year. This uplift was driven by an improvement of customer demand and mortgage rates falling. On the 4th of November 2024, the order book, excluding joint ventures, stood at £2.2 billion, or 7,716 homes, up from £1.9 billion last year. The group has been more active on land acquisitions this year, securing around 15,000 plots, as worries about tax changes in the government's budget brought new sellers to the table. As a result of the increased land buying, year-end net cash guidance has been lowered from £550 to £500 million. Full-year completion targets have been reiterated, expected to come in towards the top end of the 9,500 to 10,000 guidance range. Full-year operating profit is expected to be in line with the current market expectations, which is around 416 million. And the shares were broadly flat following the announcement. In terms of valuation, Taylor Wimpey has a market cap of £4.66 billion and trades at a forward price to book of 1.49, in line with its 10-year average, and it has a yield of 6.9%. I thought these results were good. I think you are seeing things now shifting in the right direction, so the momentum is beginning to move. It's been a very difficult couple of years for the house builders. You got used to post 2008 having incentives in the form of help to buy and also having ultra low interest rates. Obviously, that all changed a couple of years ago post COVID, so it has been difficult, and you've had the inflationary pressures. I think, and we come back to it every time with the big house builders, there's the structural trends in the UK with the demand for houses well outstripping the supply, and ongoing demographic changes in the UK and increased immigration. You only see that going in one direction, and the obvious beneficiary to that are the big house builders. I think they're in a much healthier state than they were 15 years ago, sort of pre-2008, and very good cash balances there, taking long-term strategies with the land acquisitions. So I would remain bullish on them. I have been bullish on them during the more difficult times in the last couple of years. They are, by very nature, cyclical businesses. So I think if you were buying shares in them, you have to be prepared for a bit of a roller coaster with them. But I think Taylor Wimpey going in the right direction, as are most of the other big house builders. So you could buy one of them. You could take a basket approach. I've got Redrow, but I've owned Taylor Wimpey in the past, and I've also actually owned Persimmon in the past, but all quite similar, I would say. And I don't think it's an outrageous valuation at all. It's broadly in line with its 10-year average. And I would expect, and I'm obviously personally hoping, that things continue to improve over the next couple of years. I know we did the budget special the other week, and we did talk about some of the pressures that might impose on these sorts of businesses. That is certainly going to be felt. How much so, who knows? But I think in terms of their own costs and also potential pressure on consumers on the overall market, and I guess on interest rates ultimately, which do with the house builders really flow through. So we'll see, but bullish overall, and I don't think this was a bad set of results.
I would broadly echo that. Is it all right if we move on to Novo Nordisk? Because I kind of want to save my comments until we've done Persimmon.
Fine. Okay. Yeah.
Because I think it's probably going to be better if I actually have something to compare it to, and I don't want to compare it now because I don't want to give any spoilers away. So
absolutely.
So yeah.
What about this growth stock, Sam?
So, biggest company in Europe, Novo Nordisk, have come out with their Q3 results and they have increased revenue by 23% to 71.3 billion Danish kroners when ignoring currency effects, missing consensus estimates by 1.6%. Within the core diabetes and obesity care category, growth in Ozempic was up 26% and Wegovy 81%, and that more than offset slower growth in insulin-based products. Operating profit was slightly ahead of consensus, rising 26% to 33.8 billion as revenue growth outpaced rising costs. Free cash flow over the first 9 months fell 5% to 71.8 billion, reflecting an increase in investment expenditure. Net cash at the quarter end was 17.9 billion. Spending on share buybacks fell from 20 billion to 12.7 billion. When considering dividends, total shareholder payouts has risen 9.4% to 56.8 billion. Full year guidance range was narrowed a little and now stands at 23 to 27% for sales growth and 21 to 27% for operating profit before currency impacts. Shares were up 7.6% following the results. So, Novo Nordisk's fastest growing products are the range of GLP-1 injections for the treatment of type 2 diabetes and more controversially as a weight loss aid. Concerns have emerged about the long-term safety, and Novo has attracted criticism for its marketing practices for one of its other obesity treatments. Potential restrictions on usage and marketing, as well as emerging competition, could be risks in the future. And there's also downwards pressure on pricing, particularly in the US, where the private cost of Wegovy is over $1,300 a month. So that could also be a risk. In terms of valuation, the business trades at forward PE of 27 and has a 10-year average PE of 24. Prospective yield is 1.9%, and that compares to a 10-year average of 2.1. I think from the point of view as an outsider looking in who doesn't really understand the products or the pipeline, I think these results are fantastic. I think if we compare it to GSK, which we did the other week, this is the kind of pharmaceutical company that you'd want. Whether you'd pay that much of a premium because it's almost 3 times the price of GSK, I don't know, but it's clearly a superior business, and it does actually have some hit products. I don't really understand the product. Is this the one where it's like, does it just suppress your appetite or something?
It does do that. It does do that.
Okay, that's a simplest. I feel like there's more you could have added there as a doctor, but that's
yeah.
just so I've understood it in layman's terms. But yeah, I think from my point of view, it's a fantastic business, fantastic set of results. I don't know how big the market could be. I suspect if there's no no regulatory restrictions, I suspect the market could actually be a lot bigger, even if the prices were to come down. Because I don't think there's a shortage of people that I could see wanting to use it. And I think in terms of, we're talking about tailwinds and long-term demographics, whether we like it or not, people are getting fatter. There are more obese people than there have ever been. And I think from Novo Nordisk's point of view, that's probably a potential tailwind for their products. But that being said, as good as the results are, I would have concerns over the valuation anyway, but I just wouldn't buy it because I don't understand it well enough. What about you, John, as a man with slightly more understanding?
I mean, I think you see these medications being prescribed every day. Lots of patients, even in the UK, getting them privately. Huge demand for them, both from diabetes, weight loss, and then there is a lot of other conditions that are looking as though they will benefit from GLP-1s. So I think it's definitely a growth sector. I suppose my issue with it would be about the competition, and I don't know enough about the pipeline and some of the competitors and how long they're going to be these blockbuster drugs where Novo Nordisk are benefiting from the huge demand, massively outstripping supply, and not having huge numbers of competitors in the market. How long that goes on for? I mean, at the moment, it's just boom times for them. And I think these drugs are exciting. Certainly the research that's coming out looks great and doing, a lot of good for a lot of people. But I think I probably would err away from the shares more on the basis of I don't know enough about, I suppose, that the kind of the moats that they do have. There are some big rival brands to them, but going forward, is this likely to be sustained? It's interesting though, because I know we both follow Terry Smith, and this was one of his biggest holdings previously and prior to this massive boom too.
Do you know if he still holds it?
Ooh, good question. I suspect he probably does, but I think that was when it was in the less exciting parts of the diabetes market, and still, was the biggest in Europe. But I think it's these GLP-1s particularly that seem to have really kicked things off.
So as of September 23, it was 9.8% of his portfolio.
Wow.
It was an interview he did back in May 24. So someone's asked him about his framework, and then they've said, based on the framework, is this a bit expensive? And then he said, at this point, it was trading at 45 times earnings, and the closest competitor he's highlighted was trading at a P of 74, which was even more expensive. So that was his argument. He said a P of 45 may be expensive, but not at the current growth rate, which is well over 20%, probably closer to 30. That's what we've seen in these results.
Yeah.
So the valuation will come down to pretty quickly. In 2 years' time, it'll be at a P of around 20, which is in line with the broader equity market. Can Novo Nordisk sustain that growth rate? Well, the company's clearly got a moonshot in terms of obesity, in terms of the obesity drug, and it's definitely got a lot of patent protection, but it's also got labeling protection. It says right now there's several steps ahead of the competition without reading obviously everything he said, which is quite detailed. It's quite a good interview, this, actually. Are there any other benefits to the drug? Ozempic also clearly causes a 20 to 25% reduction in major cardiovascular incidents and reduces the risk of heart attack and stroke, whether the patients are overweight or not, whether they're diabetic or not. It's going to get the same label in due course for liver and kidney problems. And it's likely to get the same level for autoimmune diseases,
Yeah.
arthritis, lupus, gout, and in due course even a treatment.
It's
God, I want some.
yeah, it's sort of this is the
Fixes
thing.
everything.
So there's a lot of research going on that is suggesting and obviously getting trials and licenses and things, but it's quite exciting. And I think as well, if you're an Novo Nordisk shareholder, it's also quite exciting. But yeah, we'll
He said
see.
as well, we did not invest in Novo because of this weight loss drug. We invested because of their superior drug discovery process, and I would not bet a lot of money against these guys coming up with something else. I mean, in fairness, in terms of the PE coming down to 20, I think he does make a good argument if it can keep the growth rate up for a couple of years.
Yeah,
I
and I
don't. I
suppose
still wouldn't buy it because I don't understand it, but I think he does make a good argument.
yeah, and I suppose the other thing is that it's listed in Europe as opposed to in the States, so
Yeah,
it's
so it could easily be
uh,
at 40 over there.
exactly, and I suppose that is essentially what he's saying, isn't it? So
Yeah,
I
he is.
suspect
Yeah,
the competitors that he's referring to are listed in the US.
yeah. I'll Google it. I think it was Eli Lilly or something.
Yeah.
Yeah, it's New York Stock Exchange.
Yeah.
P of 80.
Maybe he
So
just needs to encourage them to relist, and then
maybe, yeah. Right.
yeah.
Should we move on to a much easier business to understand?
Yeah, no, absolutely. So back to the bricks and mortar with Persimmon. They had a Q3 trading statement out last week with the group delivering 1,416 new homes in the third quarter, down 1.6% on the prior year. Average weekly net private sales rates rose 37% to zero point 0.7, with good consumer interest across all regions. Overall pricing held firm in the period, with buyer incentives contributing to the run in the region of between 4 and 5%. The order book rose from £1.7 billion to £2 billion, helped by average selling prices in the order book being 5% higher than the prior year. Demand for Persimmon's homes continued into the autumn selling season, helped by improvements in consumer sentiment as interest rates continued to fall. The group remains on track to complete around 10,500 new homes this year, compared with 9,922, 85% of which have already been exchanged or completed. And the shares were down nearly 5% in early trading. In terms of valuation, Persimmon has a market cap of £4 billion and trades at 1.33 forward price to book, compared with a 10-year average of 2, and it has a prospective dividend yield of 4.4%. Yeah, no, I thought these results were a bit disappointing. I think we're seeing better figures from Taylor Wimpey. Persimmon historically had a higher valuation, and I think there has been sort of concerns, but this is across the sector, with inflationary pressures and some of those higher costs that have come through after the budget. I think Persimmon, despite that, is still in a good position like Taylor Wimpey. I think it is still a healthy business, as are most of the big house builders in the UK. And my preference between Taylor Wimpey and Persimmon would be probably Taylor Wimpey at the moment. That being said, I think in the longer term and over the next 5 years, I think both will likely do well. But yeah, slightly behind Taylor Wimpey on these figures. Sam, what are your thoughts?
I thought it was actually quite scary how similar, excluding the cost inflation, which I'll get onto, but on the demand side, in terms of the weekly net private sales rate, the order book, the number of completions, the figures were virtually identical. So in terms of the demand side, there's obviously, I mean, they're in the same markets you'd expect, but it was scarily similar on the demand side and on the revenue side. Then you go into the costs, like you say, and Taylor Wimpey's been struggling, sorry, Persimmon's been struggling with the cost inflation more than Taylor Wimpey. And I think when on the revenue side, they're that similar, I don't see any obvious reason why their costs shouldn't be under control if Taylor Wimpey's are, which to me just suggests it's not being run as well. Now, that being said, wasn't Taylor Wimpey the one that did the land buy
It
in
was.
COVID? I think Taylor
It,
Wimpey just have better management. That's the conclusion I've come to.
yeah, I think Persimmon had some build quality issues, and they've spent the last couple of years sorting
So
that
they
side of
might have
things
inflation
out.
because they're still getting them up in terms of the quality.
I don't know. It may be that.
Okay. Even still, I think everything we've seen in the last few years since we covered them as on the show suggests that Taylor Wimpey's better run than Persimmon, I think.
Yeah, yeah,
Um, so I'd probably pick Taylor Wimpey anyway. What is it on the valuation side? Taylor Wimpey's got a better dividend as well, hasn't it?
it does.
Much better. So yeah, I'd go for Taylor Wimpey. Normally with the house builders, they're pretty similar, but I prefer Taylor Wimpey on this occasion.
Okay, fine. And what about the house building sector generally? You don't own shares currently. Would you look to?
I think if I wanted income, I probably would. I'm surprised actually. I suppose it kind of makes sense given the number of long-term tailwinds, and it's something we've talked about as the house building market has had a bit of a wobble in the last couple of years. But I didn't actually expect, and it might carry on declining again, but it seems like they're over the worst and figures are starting to pick up again. I didn't expect it to change so quickly. I kind of assumed the wobble would last a little longer, but whether that's just because they've got so many tailwinds pushing up against them, I don't know.
Yeah. No, it is interesting because if even through the bad times, obviously dividends and earnings can fall. But if you're reinvesting those dividends and it's that long-term growth, it can be a pretty good return there.
Yeah. Yeah, especially if you're reinvesting when you've got the high yields at the low in the cycle,
Yeah.
because the share price does swing around quite a lot as well. Right, should we move on to another business that has a share price that swings around a lot?
Yeah, go for it, Sam. It's following on from last week, isn't it? Upwork.
Yes, so it's the
So sorry,
competitor.
Fiverr.
Oh,
Yeah.
sorry, I thought you were talking about last week being
Well,
Upwork.
I was, but yeah, it's just to be clear, it's Fiverr
Oh
this
yeah,
week.
yeah. So this week we're doing the Upwork's competitor Fiverr. Very similar business model, so I won't go into it. But Fiverr have come out with their third quarter results, and revenue increased by 8% to $99 million, and all these figures are in dollars. Active buyers was down 9% to 3.8 million. Spend per buyer was up 9% to $296. The take rate was up from 31.3 to 33.9%. The gap gross margin was 81%, a decrease from 83.7%. Gap net income was 1.4 million or 4 cents per share compared to 3 million or 8 cents per share a year ago. Net cash from operating activities was 10.9 million. Net cash provided by operating activities, excluding one-time escrow payments for contingent consideration of 12 million, was 23 million in the third quarter compared to 23.4 million last year. So if you exclude one-off or unusual exceptional items, that's the phrase I like to use. If you exclude those, it's pretty similar. Free cash flow in the third quarter was 10.6 million. The Q4 outlook and full year guidance. So for Q4, they're guiding for revenue of 100 to 102 million, which would represent growth of 9 to 12%. And they're guiding for adjusted EBITDA of 19 to 21.5 million. For the year, they're guiding for 388 to 390 million, which would represent 7 to 8% revenue growth for the year, and adjusted EBITDA of 73 to 75 million. Operationally, they've said their strategy to lean into value-added services to drive take rate expansion continues to pay off, and they're continuing to invest in going up market to unlock long-term growth opportunities. They said the recently rolled out business rewards program on Fiverr Pro is showing promising signs to driving spend growth among larger customers, leading to more buyers spending over 10K annually on Fiverr. They launched Dynamic Matching, an AI-powered tool to provide a seamless matching experience for buyers with complex job requirements. Together with professions, catalog, and hourly-based contracts, they're enabling an end-to-end experience for businesses to search, find, and engage with talent for complex projects and longer duration. The strong performance in Q3 gave them confidence to raise their full-year guidance range for both revenue and adjusted EBITDA. This also translates into strong cash flow generation and puts them well on track to deliver the 3-year targets. So, in terms of valuation, they are trading at a market cap of 1 billion, which gives them a PE of around 110. However, the price to free cash flow is only 12.5. Now, I thought these results were worse than Upwork's. I think, although it's kind of a good thing and it's kind of not, but their take rate is far higher than Upwork's, and at 33%, it's actually at the point where you look at it and think, well, at what point does it become damaging? Because people don't want to use the platform or they want to get off the platform. Because, for example, using the example of Upwork, I mentioned last week, my girlfriend's been using it for bits and pieces, and she's actually got a job with the guy currently, and there might be more work coming from it. And she was saying to me, well, do you think I should try and do it outside of Upwork so I don't have to pay them? And my response was, well, the thing with Upwork is if there's a dispute, it's locked in escrow and you've got a degree of protection. And for me, I'd pay 10% to Upwork for that protection, unless it's someone you've been working with very long term. But after one job, I wouldn't go outside of Upwork. Now, if it was Fiverr and I was paying, I don't think it would be 33%, because I suspect it's a bit like eBay, where they take half at your end and half off the buyer's end. So you only feel like you're losing 16%. But at some point, it gets to a point where it's like your response to that is, well, actually, yeah, if you can save however much percent, you may as well go off earlier and take the risk. Or do people just go to Upwork instead because they know they can get more of their own money? My other concern is the active buyers, and I think that's partly probably because they're maybe being a bit too greedy on the take rate, because the active buyers for Fiverr was down and the revenue growth was up because they've been just increasing their take rate. Whereas with Upwork, revenue grew by a similar figure, but their clients grew 2%. Whereas Fiverr's dropped nearly 10. And I don't know if it's because they're being a bit too greedy. As well, I just think when you look at the long-term tailwinds, it's a market with so much potential growth that I would expect them to be doing a bit better. They shouldn't. I just think they're being a bit too greedy on the take rate. And I'd rather see them drop that down and see if they can get the growth up. Because I think Upwork's approach is probably better. And I think that's why Upwork has now started to put up better figures. That being said, at 12 times free cash flow or 12.5, it's still incredibly cheap. It's still putting up good numbers on the revenue side, and it's still in an industry that I think has huge tailwinds going for it. I do like both of them, and I wouldn't want to try and pick a winner, which is why I have a basket approach. That being said, my Upwork has performed far, far better than my Fiverr, but that's just mainly due to the price I got in at. But I do technically still have both, although my Upwork position is significantly larger. John, I think you've also got both. So what do you think of these results and also the comparison of them to Upwork?
I would generally agree with your analysis. I thought initially it was quite difficult, and I think there were more similarities between the strategy when we first started covering it, and you're seeing them diverge a little bit now. I divided it broadly 50-50 when I took a position in each of them, slightly weighted towards Upwork compared with Fiverr. I'm glad I did that, and it's obviously always going to be difficult to sort of pick the winner, and hence the basket approach. But yes, I think that the take rate favouring lowering that, becoming more competitive and growing the user numbers would be the way to do it. And I would like to see Fiverr do that too.
No, the only thing is, I guess we don't, because as well, it's like in the guidance is pretty good for the year, but then they don't give you guidance numbers for the users.
Yeah.
So again, it's like if they grow revenue 9 to 12%, but they're losing users. You don't want them operating like a tobacco company where they're just upping
No.
the prices
Yeah.
and seeing who drops, because they don't need to do that.
Yeah.
It's
Yeah.
just a bit, I just think it's a slightly wrong approach. And I think, like you say, they are starting to diverge a little bit now.
Yeah.
I think that's partly why, because they shouldn't be declining, I don't think, given the amount of things they've got going for them. But
No, I would agree. I would agree.
of then the 6 businesses we've covered this week, ASOS, AutoTrader, Taylor Wimpey, Novo Nordisk, Persimmon, and Fiverr, which one do you like the most and which do you like the least?
So least, very easy. I would go for ASOS. And what do I like the most? I like Novo Nordisk. I would probably still say Fiverr, with the caveat that I think the strategy could be optimized a little bit. But I think there's definitely still scope for that. Close second would be AutoTrader.
So I think least, it's an easy one. It's ASOS. Most, I think it would be Fiverr for me. I do, although there's some stuff I'm not thrilled about, at 12.5 times free cash flow for a business with that much growth potential that's growing revenue 10% a year. Yeah, for 12.5 times free cash flow, I'd argue, what more do you actually want that you're realistically going to get? So I think on valuation, it would be Fiverr. If I'm taking the performance and stuff, I think I would probably, I think Taylor Wimpey's had the best set of results. Well, Novo Nordisk because had the best set of results. But when you include valuation as well in the round, I think Taylor Wimpey's probably had the best week. So I would give it an honourable mention.
Absolutely. Well, thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.